For 5,000 years, silver was money. Not paper, not promises. Actual money you could hold, weigh, and trade anywhere on Earth. Kings minted it into coins. Empires rose and fell over it. It was as valuable as gold, sometimes more valuable. The Bible mentions 30 pieces of silver as the price of betrayal. Roman soldiers were paid in silver denarius coins. Spanish pieces of 8 silver coins became the first global currency. Why silver? Because it had everything money needs. You can divide it into smaller pieces. It doesn't rust or decay. It's scarce enough to be valuable, but common enough to use for everyday purchases. And most importantly, you can't just print more of it. For most of human history, the gold to silver ratio was about 15 to 1, meaning 15 ounces of silver would buy you 1 ounce of gold. That ratio held steady for centuries because both metals were money. In America, silver was official currency. The Coinage Act of 1792 established the silver dollar as the basic unit of money. From 1878 to 1964, the U.S. issued silver certificates, actual paper money backed by silver you could redeem. Your dollar bill said, "This certifies that there is on deposit in the Treasury of the United States 1 silver dollar payable to the bearer on demand." Real money, real silver, real value. Then, in 1965, something changed. The U.S. removed silver from quarters and dimes. The Kennedy half-dollar went from 90% silver to 40% silver, then to no silver at all by 1971. Silver certificates were discontinued. The link between silver and money was severed. Silver transitioned from money to commodity, from currency to just another metal traded on exchanges. And that's when things got weird. In 1980, silver hit an all-time high of $50 per ounce. Adjusted for inflation, that's about $180 in today's dollars. Fast forward to 2024, silver trades around $25 per ounce. Meanwhile, gold went from $850 in 1980 to over $2,000 today. Gold more than doubled, silver lost half its value. The gold to silver ratio? Today it's 80 to 1. Sometimes it hits 100 to 1. Silver got cheaper while everything else got more expensive. Houses, cars, food, education, everything costs more, except silver. And for 40 years, investors have been asking the same question: is someone manipulating the silver market? The answer is more disturbing than you think, because it's not a conspiracy theory. Banks have been caught multiple times and fined billions of dollars for rigging silver prices. This is the story of the biggest, longest-running market manipulation in history, and it might still be happening. Dallas, Texas. 2 oil billionaires named Nelson Bunker Hunt and William Herbert Hunt looked at the American economy and didn't like what they saw. President Nixon had just taken the U.S. off the gold standard. The dollar was no longer backed by anything real. It was pure fiat currency, paper backed by government promises. Inflation was exploding. The value of the dollar was collapsing. The Hunt brothers, worth billions from their Texas oil fortune, decided to protect their wealth. How? By buying silver. Lots of it. Their logic was simple. You can't print silver. There's only so much in the world. And if the dollar collapses, people will need real money again. Silver had been money for 5,000 years. It could be money again. So they started buying. Not just a little. They bought physical silver bars, millions of ounces stored in vaults. They bought silver futures contracts, agreements to buy silver in the future at today's price. They bought so much silver that they started moving the entire global market. Here's how much they accumulated. By January 1980, the Hunt brothers and their associates controlled over 100 million ounces of physical silver stored in vaults. That's roughly 1/3 of the entire world's deliverable supply. Think about that. 2 brothers from Texas owned 1/3 of all the silver available for immediate delivery on Earth. The price reacted exactly as you'd expect. In 1979, silver was trading around $6 per ounce. By January 21, 1980, it hit $49.45 per ounce. The Hunt brothers' silver holdings were worth over $5 billion on paper. At the time, that was an unimaginable fortune. They thought they'd won. They'd cornered the silver market. They'd protected their wealth from inflation. They were geniuses. But then came the crash. The exchanges and regulators realized what was happening. The Hunts weren't just investing, they were manipulating the market, controlling supply, driving prices to artificial levels. So the COMEX exchange changed the rules. In January 1980, they implemented Silver Rule 7, limiting how many futures contracts one person could hold and requiring much higher margin deposits. Suddenly, the Hunts had to put up massive amounts of cash just to hold their positions. They couldn't. They didn't have enough liquid cash. They were rich in oil and silver, but cash poor. Then came March 27, 1980, a date that would live in infamy in silver markets. Silver Thursday. The Hunt brothers got margin calls, demands to deposit more cash or their positions would be liquidated. They couldn't meet the calls. Brokers started force-selling their silver positions. The price collapsed. In a matter of weeks, silver went from $50 to under $11 per ounce. The Hunt brothers lost billions. Their $5 billion fortune evaporated. By 1988, they declared bankruptcy. Nelson Bunker Hunt famously said after losing his fortune, "$1 billion isn't what it used to be." The Hunt brothers' attempt to corner the silver market failed, but it proved something important. Silver markets could be manipulated. The price wasn't set by free markets and supply and demand. It was set by whoever had enough power to move it. And that lesson wasn't lost on the big banks. For most of the 20th century, the price of silver wasn't determined by a free market. It was decided by 5 banks in a room, literally. From 1897 to 2014, that's 117 years, the global benchmark price for silver was set through something called the London Silver Fix. Every day at noon, representatives from 5 banks would gather in a wood-paneled room in London or call each other on the phone. The banks, Deutsche Bank, HSBC, Bank of Nova Scotia, and later others. They would share information about their clients' buy and sell orders, then agree on a price. That price became the global benchmark. Refineries, miners, investors, manufacturers, everyone used the London Silver Fix as the official price of silver. Sounds fair, right? Major banks working together to ensure accurate pricing? Except they weren't working together. They were conspiring together. In 2013, a whistleblower from Deutsche Bank came forward with evidence. The banks weren't just setting prices based on supply and demand. They were manipulating the fix to benefit their own trading positions. Here's how it worked. Before the daily fix, the banks would share information about large client orders. If they knew a big buyer was coming, they'd buy silver first, drive the price up during the fix, then sell to the client at the higher price. If a big seller was coming, they'd short silver, crash the price during the fix, then buy from the client cheap. The evidence was damning. Emails, chat logs, traders joking about manipulating prices. One leaked message said, "They're going to wax silver again," meaning we're going to manipulate the price downward. In 2013, the scandal went public. Class action lawsuits were filed. The banks settled. Deutsche Bank paid $38 million. HSBC and Bank of Nova Scotia paid a combined $15 million. Total settlements around $50 million. For over a decade of manipulating the global silver market, affecting millions of investors and billions of dollars in transactions, the banks paid $50 million and admitted no wrongdoing. Let that sink in. They rigged the price of silver for years, got caught, paid a fine smaller than the annual salary of their CEOs, and nobody went to jail. The London Silver Fix was shut down in 2014 and replaced with an electronic auction system. But the damage was done. Trust was shattered, and a question lingered. If they were manipulating silver for over a decade and only paid $50 million, what else are they manipulating? But the story doesn't end there, because an even bigger scandal was about to break. While the London silver fix scandal was making headlines, something far worse was happening in America. J.P. Morgan Chase, the largest bank in the United States, was systematically manipulating precious metals markets, not for a few years, for nearly a decade, and not through some secretive fix in a London boardroom, through outright fraud on American exchanges. The technique was called spoofing, and it's as illegal as it sounds. Here's how spoofing works. Imagine you're at an auction. You want to buy a painting, but you want it cheap, so you yell out, "I'll pay $1 million for that painting." Everyone hears you. Other bidders think, "Wow, someone's willing to pay $1 million. I'd better bid higher." The price starts climbing. Then, just before the auction ends, you cancel your bid. Just kidding. The other bidders are confused. The price drops, and you swoop in and buy the painting at the lower price. That's spoofing. It's market manipulation, it's fraud, and it's exactly what J.P. Morgan traders were doing thousands of times between 2008 and 2016. The traders would place huge buy orders for silver futures. The market would see those orders and think, "Big buyer coming in, price is going up." Other traders would rush to buy, the price would rise. Then J.P. Morgan would cancel the fake orders and sell silver at the artificially higher price. Or they'd do the reverse, place huge sell orders, crash the price, then buy cheap after canceling the fake orders. The evidence was damning. Emails, chat logs, traders joking about manipulating prices. One leaked message said, "They're going to wax silver again," meaning we're going to manipulate the price downward. In 2019, the Department of Justice filed criminal charges, not against the bank, against the individual traders. The trial revealed shocking details. Traders testified that spoofing was common practice encouraged by management and incredibly profitable. They made millions for the bank and for themselves. In 2020, J.P. Morgan reached a settlement with the DOJ and CFTC. The fine? $920 million. That's not a typo. $920 million, the largest precious metals manipulation penalty in history. But here's the kicker. J.P. Morgan didn't admit wrongdoing. They just paid the fine. The bank itself faced no criminal charges, and the traders, Michael Nowak and Greg Smith, were convicted in 2023 and sentenced to prison. Nowak got 1 year and 1 day. Smith got 1 year. Let's do the math. J.P. Morgan manipulated precious metals for 8 years. They made billions in illegal profits. They paid a $920 million fine, and 2 traders got 1 year in prison each. The bank kept the profits. The shareholders weren't punished. The executives who oversaw the traders kept their jobs and bonuses. And here's the really disturbing part. If J.P. Morgan was doing this from 2008 to 2016 and only got caught because whistleblowers came forward, what were they doing before 2008? What other banks are doing right now? So we know banks manipulated silver. The London fix was rigged. J.P. Morgan spoofed markets for years. Those are facts, court records, admitted settlements. But there's a bigger theory, a more systematic conspiracy, and this one is harder to prove, but also harder to dismiss. The theory, major banks hold massive short positions in silver to artificially suppress the price, not just for profit, but to protect the value of the dollar and hide inflation. Let me explain short selling first. Normal investing, you buy silver at $20, sell it at $30, make $10 profit. Short selling, you borrow silver, sell it at $30, hope the price drops, buy it back at $20, return what you borrowed, and keep the $10 difference. You profit when prices fall. Now, the allegation. Banks have been holding enormous short positions in silver for decades, so enormous that they're not hedges or normal trading, they're price suppression. The evidence? CFTC data. The Commodity Futures Trading Commission publishes weekly reports showing who holds long positions, betting prices rise, and short positions, betting prices fall in commodity markets. For years, a small number of banks have held concentrated short positions in silver. Analyst Ted Butler spent over 30 years studying these reports. His conclusion? A few banks, especially JP Morgan, held short positions so large they could only exist to manipulate prices. Butler's most explosive claim: while JP Morgan was publicly shorting silver in the futures market, they were secretly accumulating physical silver. By 2020, Butler estimated JP Morgan had accumulated nearly 1 billion ounces of physical silver, the largest private silver hoard in history. Think about that. Short the paper market, driving prices down, buy the physical metal cheap. Then, when manipulation ends, prices explode and you own 1 billion ounces. If true, it's the greatest trade in history and the most criminal. But there's a problem with the theory. Nobody can prove it definitively. JP Morgan has never confirmed how much physical silver they own. The CFTC has investigated and said they found no manipulation. Defenders argue the short positions are legitimate hedges for mining companies. Then came February 2021. The Wall Street Bets crowd, the Reddit investors who squeezed GameStop, decided to try a silver squeeze. The idea: buy so much physical silver that the paper market collapses, force short sellers to cover at massive losses, break the manipulation. They bought billions in silver. The hashtag silver squeeze trended worldwide. Physical silver sold out at dealers. Premiums skyrocketed. And the price? It went from $25 to $30, then back to $25. The squeeze failed. Why? Because the paper market is too big. There are hundreds of millions of ounces of paper silver traded daily. Futures contracts, ETFs, bank trades. The physical market is tiny by comparison. As long as the price is set by paper contracts, not physical metal, the paper market sets the price, and the paper market is controlled by the big banks. Today, the CFTC reports still show concentrated short positions in silver. The gold-to-silver ratio is still around 80-1, far from the historical 15-1. Silver remains cheap despite growing industrial demand. 50% of silver is used in solar panels, electronics, and medical devices, industries that are booming. And here's the paradox. Since 2021, the world has consumed more silver than it produces. There's an annual deficit. Basic economics says demand exceeds supply, price should rise. But silver? It stays around $25 per ounce. Either the manipulation continues, or there's an explanation nobody's figured out yet.
So let's be clear about what we know. Silver was manipulated. That's not theory, that's fact. The London silver fix was rigged from 2007 to 2013 at minimum. Banks admitted it, paid fines. The fix was shut down. JP Morgan manipulated precious metals markets from 2008 to 2016. Thousands of documented instances, $920 million fine, traders convicted and imprisoned. Those are the facts. Silver manipulation happened. Banks were caught, they paid fines, and they kept their profits. Now let's talk about what's debatable. Is silver still being manipulated today? That's where opinions divide. The bull case says yes. Look at the data. Concentrated short positions haven't disappeared. The gold-silver ratio is still broken. Industrial demand grows, but prices stay flat. It defies economics. The manipulation continues because nobody was truly punished. A $920 million fine to a bank that makes $50 billion in annual revenue? That's a cost of doing business. The bear case says no. The London fix is gone. JP Morgan got caught and fined. Markets are now electronic and transparent. The shorts are legitimate hedges from mining companies protecting against price drops. Silver is properly valued. The conspiracy theorists are wrong. The truth? Probably somewhere in the middle. Here's what's undeniable. Silver went from being money for 5,000 years to a manipulated commodity in less than a century. Banks have been caught rigging the price, not once but multiple times. The penalties were tiny compared to the crime, and trust in the market has been destroyed. Bart Chilton, a former CFTC commissioner, spent years investigating silver. In 2010, he publicly stated, "I believe there have been repeated attempts to influence prices in silver markets. The silver market has been subject to fraudulent efforts to persuade and deviously control the price." Chilton died in 2019. He never lived to see the JP Morgan convictions that proved he was right. So what happens next? Three possibilities. Scenario 1, the manipulation ends. The big shorts get squeezed or voluntarily close positions. Silver catches up to gold. The ratio returns to historical 15-1. Silver hits $100 plus per ounce. Everyone who held physical silver through decades of suppression gets vindicated. Scenario 2, status quo continues. Silver stays range-bound between $20 and $30. The paper market controls the price. Industrial demand grows, but prices stay flat. The gold-silver ratio stays broken, and conspiracy theorists keep claiming manipulation while skeptics dismiss them. Scenario 3, the conspiracy is wrong. Silver is properly valued. Mining supply increases. Substitutes replace silver in industrial use. Prices drift lower, and the manipulation claims are proven to be just paranoid investors looking for excuses. Which scenario happens? Nobody knows. But here's what we do know. Markets are only free if they're fair. If banks can rig prices for decades, pay small fines, and keep their profits, then markets aren't free, they're rigged. Silver went from money to commodity to crime scene, and most people have no idea. Whether silver explodes to $100 or stays at $25, one thing is certain. The market hasn't been free, it hasn't been fair, and the people who rigged it paid fines but kept their profits. Welcome to modern markets, where manipulation is just a cost of doing business, where banks are too big to jail, where fines are tiny and crimes are massive. The Hunt brothers tried to corner silver and lost everything. JP Morgan traders spoofed markets for years and got 1 year in prison. Banks manipulated the London Fix and paid $50 million. The lesson? If you're rich enough, powerful enough, and connected enough, market manipulation is just another Tuesday. And silver? It's still $25 per ounce, still trading at 80 times the price of gold, still defying basic economics. Maybe that's the real manipulation. Not that silver is suppressed, but that nobody cares enough to fix it.